Hello everyone. Investing in stocks is one of the most powerful ways people build wealth over time. You've likely heard stories about investors growing their money, retiring early, or achieving financial freedom through the stock market. But alongside those success stories, there's an equally important question that every investor, especially beginners, must ask: what are the risks of investing in stocks? Understanding risk is not optional. It is not something you learn after you start investing. It is the foundation that determines whether investing becomes a tool for long-term wealth or a source of stress and costly mistakes. In this video, we are going to explore the real risks of investing in stocks, what they are, why they exist, and how investors think about them. The goal is not to scare you away from investing, but to help you approach it with clarity, realism, and discipline. By the end of this video, you will understand why stock market risk exists, the different types of risk investors face, how risk affects beginners differently than experienced investors, why risk is not always a bad thing, and how successful investors manage risk over time. So relax, get comfortable, and let's get started. So what does risk mean in stock investing? Before we can talk about the risks of investing in stocks, we need to define what risk actually means in this context. In investing, risk refers to the possibility that the outcome will be different from what you expect, especially the possibility of losing money or earning less than anticipated. Risk does not mean that you will lose money. It means that the future is uncertain. When you invest in stocks, you are making a decision today based on assumptions about the future. Some of these assumptions might be that a company will continue to operate, that a company will remain profitable, that demand for a company's products or services will persist, or that the broader economy will support growth. Anytime the future is involved, risk exists. For beginner investors, risk often feels emotional. It shows up as fear, hesitation, or anxiety. But for experienced investors, risk is treated as something measurable, manageable, and expected. Understanding risk means accepting one core truth, and that is there is no reward in investing without risk. So why do stocks have risks in the first place? A common beginner question is, why are stocks risky at all? Why don't they just go up over time without setbacks? The answer lies in what stocks represent. When you buy a stock, you are buying ownership in a real business. Businesses operate in the real world, and the real world is unpredictable. Companies face competition, changing customer preferences, rising costs, economic slowdowns, regulatory changes, and management decisions that may succeed or fail. Because stocks reflect the value of businesses, they inherit all of this uncertainty. Additionally, stock prices are influenced not only by business performance, but by human behavior. Markets are driven by millions of investors making decisions based on emotion, expectations, fear, and optimism. This combination of real-world uncertainty and human psychology is what creates risk in the stock market. So can you lose money investing in stocks? One of the most direct and important questions beginners ask is, can you lose money investing in stocks? The honest answer is yes. Stock prices can decline, companies can underperform, markets can enter prolonged downturns. In some cases, individual companies can fail entirely. Losses can happen in several ways. For example, you buy a stock and its price falls, you sell during a market downturn, a company's earnings collapses, or a business goes bankrupt. However, it's critical to understand how and why losses occur. Most long-term losses for beginner investors are not caused by the stock market itself, but by emotional decision-making, panic selling, lack of diversification, poor understanding of what they own, and short-term thinking applied to long-term assets. Losses are possible, but they are not random. They tend to follow predictable patterns of behavior. So what is market risk? Market risk refers to the possibility that the entire stock market declines, taking many stocks down with it, even strong companies. This can happen during recessions, financial crises, periods of high inflation, global uncertainty, and sudden economic shocks. During these periods, even profitable, well-managed companies may see their stock prices fall. This is because investors pull money out of the market broadly, not because every company is failing. Market risk cannot be eliminated entirely. If you invest in stocks, you are exposed to the ups and downs of the market as a whole. However, market risk behaves differently over different time frames. In the short term, markets can be volatile and unpredictable. Over long periods, markets have historically trended upward. This is why time horizon is one of the most important factors in managing risk. So what is a company-specific risk? Another major category of risk is company-specific risk, sometimes called individual stock risk. This refers to risks that affect a particular company rather than the entire market. Examples include poor management decisions, declining product relevance, legal issues or lawsuits, accounting scandals, and loss of competitive advantage. Unlike market risk, company-specific risk can be reduced through diversification. If you invest all your money in a single company, your financial outcome depends heavily on that one business. If something goes wrong, your portfolio suffers significantly. This is why beginner investors are often advised not to concentrate their investments in just one or two stocks. So what is volatility and why does it matter? A term beginners frequently hear is volatility, but what does it actually mean? Volatility refers to how much and how quickly a stock's price moves up and down. Highly volatile stocks experience large price swings, can rise or fall dramatically in short periods, and often react strongly to news or earnings reports. Low volatility stocks tend to move more gradually, are often established, see slower growth, and may provide more stability. Volatility itself is not risk, but how you react to volatility can create risk. For beginner investors, volatility often leads to emotional decisions, buying after prices rise, selling after prices fall, and reacting to headlines instead of fundamentals. Learning to tolerate volatility is one of the most important skills in investing. So what is emotional risk in investing? One of the most underestimated risks in investing is emotional risk. Emotional risk refers to the danger of making poor decisions based on fear, greed, impatience, or overconfidence. Common emotional mistakes include panic selling during market downturns, chasing hot stocks after big gains, overtrading, ignoring long-term plans, and refusing to admit mistakes. The stock market constantly tests emotions. Prices move daily, news cycles are relentless, and opinions are everywhere. Successful investors recognize that managing emotions is just as important as analyzing numbers. So is investing in stocks the same as gambling? A question many beginners ask is investing in stocks just gambling? The answer depends on how you invest. Gambling involves short-term outcomes, random chance, and no underlying value creation. Investing involves ownership of productive assets, long-term value creation, research and analysis, and measurable fundamentals. When investors buy stocks based on hype, rumors, or emotion, it begins to resemble gambling. But when they invest with discipline, diversification, and a long-term strategy, it becomes a calculated process of wealth building. Risk exists in both, but the nature of the risk is fundamentally different. So how does time reduce risk in stock investing? One of the most important ideas for beginners to understand is the relationship between time and risk. In the short term, stock prices are unpredictable. Over days, weeks, or even months, markets can move sharply in either direction. Over long periods, however, time allows economic growth, business expansion, compounding returns, and recovery from downturns. Historically, investors who stay invested over long time horizons experience significantly lower risk than those who constantly move in and out of the market. Time does not eliminate risk, but it smooths it. So how do investors manage risks without avoiding stocks? If stocks carry risk, the next logical question is, how do investors manage risk without avoiding stocks entirely? Common risk management strategies include diversification across companies and sectors, long-term investing, regular investing over time, avoiding excessive leverage, understanding what you own, and maintaining realistic expectations. Risk management is not about eliminating uncertainty. It's about controlling what you can and accepting what you cannot. So how should beginner investors think about risks? Risk should be viewed as a normal part of investing, something that changes over time, something that can be managed, not eliminated, and a trade-off for potential growth. The goal is not to avoid risk, but to take appropriate risk based on time horizon, financial goals, emotional tolerance, and knowledge level. Understanding your relationship with risk is more important than predicting markets. Investing in stocks involves real risks, but those risks are not mysterious or uncontrollable. Stock market risk exists because the future is uncertain, businesses operate in changing environments, and markets reflect human behavior. However, risk does not mean recklessness. With education, discipline, and long-term thinking, risk becomes something investors work with, not something they fear. Understanding risk is the step that transforms investing from speculation into strategy. In the next stage of learning, the focus shifts from what risk is to how investors balance risk and reward, and how smart decisions are made despite uncertainty. That understanding is what separates long-term investors from short-term mistakes. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.